done at the end of 2017, we're projected to increase the federal budget deficit by about 1.5 trillion. Now that deficit actually may end up widening just because spending, there's still going to be spending. However, Congress does have certain caps and rules regarding deficits. So I think we have to keep an eye on things, and hopefully, given that the deficits are going to stay the way they are or even increase, that it again may make retirement plans a ready target to raise revenue. So again, we'll have to keep an eye on that. Okay, next is interest rates, and that's certainly interest rates have been front and center last year and also this year, and really what's kind of at the core of the interest rate discussion is the yield curve. Okay, what is a yield curve? The yield curve is just what are the yields on treasuries for varying maturities. And there are really two parts of the yield curve that we want to look at in terms of how it impacts the economy and savings. One is the short-term part, the short end, which is less than 1 year maturity, and that's impacted a lot by the Federal Reserve. Well, the Federal Reserve, it's kind of hard to believe, but they actually raised rates 4 times in 2018. Now, they raised rates for several reasons, having to do with what they believe was a very strong U.S. economy and job market. And they had some fear that the economy might actually overheat and there might be more inflation than they wanted to see. Okay, I mean, we'll see in a moment that that's really has been pretty much an unfounded fear. Raise or not raise in 2019? That's the question right now. I would say that the Federal Reserve's on pause, so there's about a 1 in 4 chance that there'll be another increase in 2019, but we'll have to wait and see. Another important thing, when looking at how interest rates and yields work, is kind of the tension that that has been between the Federal Reserve and the executive branch. As you've probably read in the news, that the administration has criticized the Fed for raising rates, and the Fed will come back and say, "Well, we're independent. That's our mandate is to be independent from the president and the executive branch." So that's calmed down a little bit, but we'll have to keep an eye on that. Okay, so that's kind of the short end of the yield curve. Now, the intermediate and long term go from 1 to 30 years, and those are the long end is impacted by not so much the Fed, but by inflation. Okay, what's sort of the expected inflation, going out in time, economic growth, federal deficits, and the supply and demand in the bond markets for U.S. and non-U.S. investors. So it's kind of a different bunch of things which determine whether long-term interest rates go up or go down. And just looking at this graph, it's a little, just kind of focus on the right-hand side, and it's a little bit hard to see the numbers, but this graph is another way of measuring how much inflation investors expect, and it's actually known as the TIPS break-even point. One of our 401k options are Treasury inflated protection securities, or TIPS, and actually the way that they trade kind of can give an idea of inflation, and it's down around 1.8%. The Fed is targeting 2%, so inflation really isn't that much of a threat, and that's probably bodes it bodes well for longer term interest rates, that they're not going to be shooting up anytime soon. Right now, the 10-year yield is around 2.8%, and the 30 is a little around 3%. Okay. Now, what does the yield curve look like now? Okay. If you look at this, this started a couple of months ago, and it's not typically what you see in the yield curve. I mean, logically, the yield curve should always be sloping upward, meaning that the longer the maturity, the higher the yield, which kind of makes sense. You expect, something with a bond with a 5-year maturity to yield more than one with a 1-year maturity. However, because of the Fed and because of some other things in the economy, the Fed increases, the yield curve began to invert in late 2018. So you may have seen that in the news, the yield curve beginning to invert. And if you look at this graph here, which was from a few days ago, you see the circle on the 1-year and the circle on the 5-year. Well, the 1-year yield is higher than the 5-year. Okay, so that's what's known as an inverted yield curve. Okay, now the thing to say here is, okay, the rest of the curve is pretty well, normally sloped. But what might happen is if we have the 1-year yield being actually greater than, say, the 10-year, so you're even getting a real big inversion, then historically, when there's been big inversions, that's been a leading indicator of recessions. Okay, doesn't mean it's going to happen, but when I say leading indicator, it's usually 6 to 12 months later there's been a recession. Now, that's not saying that right now the yield curve is going to predict a recession, but certainly, it's something to keep an eye on. Okay, what about interest rates and savers and pension funds? Higher short-term rates will, help retiree savers that invest in CDs, certainly. The downside of it, just in terms of the financial sector, is that it's going to hurt financial institutions, because if yield curve inverts, then the savings rates that banks have to offer, that spread between that and the lending rates for the longer term is going to narrow. So that's going to hurt profits. Okay, what about pensions and funded ratios? I think in that case we want to focus a little more on the longer term rates, and I think there are a couple of things. First of all, if there are higher, if longer term interest rates do go up because of inflation or the economy, that's going to lower the value of fixed income holdings, but is also going to lower liabilities. But the key question is whether higher interest rates actually slow down the economy. Because if it does, then you may have lower liabilities, but you're going to have lower assets as well. So it's not going to help your funded ratio as much. And sort of the opposite in terms of, lower interest rates might increase your liabilities, but if they help if the economy, the asset returns behave, then that'll sort of offset it. So there are a number of sort of intertwined things which involve long-term interest rates. And I said, I think the main thing to keep in mind this year, will be the shape of the yield curve and whether there's further inversion. Okay, this slide just shows average 1-year CD rates, and as expected, at the end of 2017 to the end of 2018, and these are just averages for 1 year, they've actually doubled. Okay, and in a lot of ways, it pretty much coincides with the 4 times that the Federal Reserve raised interest rates. Okay, third, let's talk a little bit about the fiduciary standard. Okay, and things happened in 2018 which were not totally expected. The move toward a uniform fiduciary standard, which was really the DOL standard, was disrupted in 2018. So that DOL standard, which was known as the conflict of interest rule, was repealed by a federal court. So, that rule was really going to become pretty much the federal standard, but you had this repeal. Now you still have, fiduciary standards on the books, but this was much more comprehensive. Okay, who stepped into the gap here? Well, the SEC in 2018 issued its proposed best interest standards for broker-dealers, and that involves reasonable diligence, care, skill, and prudence. Okay, these were proposed. They have not been finalized. Also, the states have been beginning to step in, proposing their own fiduciary regulations. New Jersey, for example, has proposed and started hearings on standards for brokers and RIAs. So where is this all headed in 2019? Because it's certainly gotten murkier, but hopefully whatever the DOL comes up with now and the SEC might be combined, and there will be more uniformity. Okay, as I said before, though, even though the fiduciary rule or the final fiduciary rule is still kind of in process, there have been standards on the books, going back to the 2000s. So, in other words, there still are action items, or definitely action items the plan sponsors have to continue to abide by. And I won't go over each of these in detail, and this is not an exhaustive list, but reviewing procedures, vendor compensation, conflicts, review investment guidelines and policy statements, and Pentegra, as its key role as a fiduciary, certainly is involved very much, of course, in the fiduciary standards. So again, it's just important to understand that there are going to be things going on from a from a legal standpoint, and in terms of different parties with standards, but they're still on the books, the fiduciary standard. Okay, next, I'll talk about a topic which, it's not it's not something here, and it's obviously something that's political as much as anything, but Medicare for All, which I can also is very much related to universal health care. Okay, it certainly remains years away, if it ever does happen, as an alternative solution for healthcare delivery. But it has been getting more play, and there certainly is going to be increased discussion of Medicare for All. And just to give a little background on that, in Medicare for All, the government is the sole payer. Okay, they pay the bills. However, it's not socialized medicine. You still have a private market for healthcare providers. So it's really in this case Medicare, the government actually sort of paying the bills and administering the healthcare system. Political, social dynamics. I mean, again, there's been a lot of discussion. There have been not that many studies, but there have been a few. And it comes down to, at least at this point, you're going to have a big cost to the federal budget. Okay, it's going to cost a lot to, the program's going to cost in the trillions. However, the arguments in favor of Medicare for All would be lower reimbursement rates, lower administrative costs, and lower prescription drug prices. Okay, so it's really, it's unclear at this point, whether the costs are, significantly higher than the benefits or not, and that's going to continue to be discussed. Congressional proposals, there have been a number of them for Medicare for All. The latest was 2017, the Bernie Sanders proposal. Several states have proposed government-sponsored single-payer systems. Of course, the ACA, the Affordable Care Act, that's the platform, delivery platform now, or one of the major ones. So there has to be certainly consideration of, if there, first of all, how is the ACA going to evolve, and how will that be able to transition to a universal health care system? Okay, again, though, these Medicare for All is certainly not something that's going to happen in the next few years, but it is being discussed. Finally, if we look at the OECD countries, there are 34 members. There are only 3 countries that don't have universal health care. That's Greece, Poland, and the United States. So will the U.S. eventually join the list? That's to be determined. Okay. The last trend or last topic is ETFs, or exchange-traded funds. This was something that I discussed in my PENTalk a year ago, but ETFs continue to grow significantly, and with growing popularity among advisors. And when we talk about advisors, we're not only talking about human advisors, but also robo-advisors. I won't get into a lot about robo-advisors, but certainly that's another topic for discussion. Robo-advisors, they're certainly not robots, at least at this point, but they're can be considered an online service which has algorithms which provide automated investment portfolios. That's one way of defining it. And often, they work in concert with human advisors. The thing about robo-advisors is their algorithms are written in such a way where if there's rebalancing to be done between asset classes, and the markets are very volatile, robo-advisors will tend to use ETFs to move money very quickly. And there was a lot of movement when the market started correcting between equity ETFs and shorter-term fixed income ETFs. Okay, ETFs are still a relatively small fraction of all funds, about 15%. However, there's been excess of 20% growth rate in ETF assets over the 10-year period ending 2017. I would expect 2018 to be another big year as far as growth. So the ETFs allow real-time pricing, buy, sells, lots of sectors, and expense ratios on average are between index funds and actively managed funds. Again, we have a lot of ETFs out there, but in terms of really a long-term track record, so far it's really been the oldest and largest that have thrived and survived, such as the Vanguards and the Fidelities. Okay, and then just to show the graph, net assets, the number of ETFs, you see how it's grown from 531 billion to 3.4 trillion at the end of 2017. Okay, well, I'd like to thank you again for calling in, and Beth, I'll let you sort of wrap up, and certainly if anyone has any questions now or follow up,
right.
Please feel free to let me know.
Yes, we do have a couple of questions, Fred. First, I'm sure this is on. I've had 2 questions on this. Are we headed into a recession in 2019?
Okay, that's a great question, and wish we all had a crystal ball. But right now, uh, the economists are putting a probability of recession at about 25% now for 2019, but somewhat higher for 2020. Um, the reason I would say the people were forecasting almost a 0% in 2019, probably midway through 2018, but a number of things have happened which kind of have raised some concern, or at least raised the odds. One, as I mentioned before, the yield curve inversion. Also, economies such as China and Europe have been slowing down, so that has a big impact. Tariffs, just the whole, the tariffs have been put in, and the tariff, the back and forth, the rhetoric, and so on, that hasn't helped things. And then finally, is the Fed going to actually raise rates even more in 2019? And there's a fear that if they do, that could really, tip the economy more toward a recession. I mean, right now, if you look at, the U.S. economy is still, pretty solid by a number of indicators. Certainly the job numbers recently have been pretty good, but there are soft spots, and we are a global economy. So, as I would say, I think the likelihood of a recession is not that big. It's reasonably small in 2019. 2020 could be another story.
Great, thank you. And we have maybe 1 minute left for you to answer one more question. How do investors deal with the volatility that we've seen over the last couple of quarters as it relates to asset allocation?
Yeah, I think the byword is diversification. Among asset classes. I think in terms of what institutions have been doing, I would say on the whole they've gotten a little more conservative. In other words, a little more fixed income oriented, particularly shorter term fixed income. So there has been, I think, something of a shift toward fixed income. However, and we can't even, equities, certainly didn't do well at all at the end of 2018. They've come back a little bit in 2019. So certainly, keeping some exposure to equities makes sense as well. But I would say that, just, sticking to diversification, risk tolerance, those type of things are really, I think, the best ways to, to deal with volatility, because, market timing is extremely difficult.
Great. Thanks, Fred. And thank you for being here today. And thank you, everyone out there on the webinar for tuning in. Join us in February. We'll have another great PENTalk lined up. Thanks again, Fred.
Thank you.